This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Rate rage. The August employment report intensifies an already heated debate over the Federal Reserve, interest rates, and your money. Where the jobs are and aren't. The industry is expanding their ranks and the one that is shrinking. And a win-win. Meet the entrepreneur who found its success off the court while coaching student athletes on the field. All that and more tonight on Nightly Business Report for Friday, September 4th. Good evening, everyone. I'm Sue Herrera. Tyler Matheson is off this evening. Just strong enough. That's how the August employment report is being characterized by some. And it was also just strong enough to punish stocks. The Dow Jones Industrial Average plummeted 272 points to 16,102 in reaction to that jobs number. It was off about 350 points midday. The Nasdaq dropped 49 and the S&P 500 fell 29. The concern in the markets is what it has always been, the timing of a rate hike. And the stronger the number, the greater the possibility the Fed could raise rates at its next meeting in just 2 weeks' time. The economy created 173,000 new jobs last month, fewer than expected. However, the unemployment rate at 5.1% was the lowest in more than 7 years. But as Hampton Pearson tells us, what the Fed does next is anything but definitive.
In August, headline unemployment fell to a 7-year low, but hiring was the slowest in 5 months. However, job growth for the last 3 months has averaged 221,000, after the government revised job growth upward for June and July by 44,000. But wage growth, at just over 2% over the last year, is still below normal for recovery. Lots of Americans remain on the sidelines. At 62.6%, the labor force participation rate remains at a 38-year low. Enough ammunition, leading economists say, for monetary policymakers on both sides of the debate on raising interest rates.
I still see reasons for anxiety when we get a lower than expected number like this.
But I'm pretty confident that this number is strong enough, especially with the unemployment rate, to get the Fed to move.
Healthcare continues to lead the way for job growth, creating nearly 500,000 new jobs so far this year.
What we're aiming to do is create a comfortable, high-quality, high-touch setting so that patients feel really comfortable, have easy access to their doctors and primary care providers.
Dr. Will Kimbrough is on the front lines of a makeover of the $125 billion primary care business, running the Washington, D.C. offices of One Medical Group, the fastest growing primary care network in the country with 40 locations in 7 metro areas. Patients can book same-day appointments through the company's online and mobile apps, as well as use customized electronic medical records. The goal, to make the doctor-patient relationship more efficient. Among the more than 300 new workers hired nationwide this year is Sarah McCormick, an experienced nurse, being given a chance to reinvent her job.
I'm used to seeing patients on the back end of things when the problems have already created, and they're in the hospital.
Heading into Labor Day, 8 million Americans have found jobs in the last 3 years, and the unemployment rate is at its lowest level since 2008. But even top government officials agree wage growth has been the missing piece in this recovery. For Nightly Business Report, I'm Hampton Pearson in Washington.
And as Hampton just reported, the healthcare industry is indeed leading the way in job creation. But as Morgan Brennan tells us, there's one sector that is still suffering job losses, and that is energy.
The mining sector, which includes oil and gas, shed another 9,000 jobs in August. The Labor Department says that brings the total losses up to 90,000 since December. We've seen declines every month this year, but the cuts seem to once again be gaining momentum. Many in the sector have been keeping tabs on announced layoffs. Oil consultancy Graves & Company says BP, Sandridge Energy, and National Oil Well Varco are a few of the companies that announced stateside cuts in August. And with crude prices again sliding below $50 a barrel, experts say more cuts are coming.
There's no doubt that there's going to be scores of thousands of layoffs announced over the coming months as the industry retrenches because of this low price environment.
Earlier this week, oil and gas giant ConocoPhillips announced it would slash 10% of its workforce. But it's no longer just energy companies laying off workers either. The pain is rippling out to other industries as well. Last month, manufacturing shed 17,000 jobs, and a big chunk, 7,000, were in fabricated metal, which has been dented by a steep drop in demand for products used in drilling. The sector is now basically flat in terms of job growth for the year. Still, U.S. Deputy Labor Secretary Chris Liu says there could be a long-term solution to address some of these losses.
Whether it's manufacturing, whether it's construction, there's clearly much more we should do. And we have a solution, and that's passing a long-term infrastructure bill that produces the kinds of jobs in both of those sectors. Those are good, middle-paying jobs that get Americans back to work.
But whether and how Congress chooses to tackle that subject when work commences again next week is a big question mark. Meantime, with commodity prices so low, the pain, as evidenced in today's report, keeps coming to the oil patch. For Nightly Business Report, I'm Morgan Brennan.
For more analysis now on the labor market and the Fed, let's turn to Milan Moraine. He is Deputy Chief U.S. Economist at TD Securities. Welcome. It's nice to have you here, Milan.
Thanks for having me.
You say that this is a broadly positive report. I mean, energy is a special situation, certainly, but you saw a lot of positives in this report.
Yeah, no, absolutely. I think this report strikes a number of right chords for the Fed, and when they meet in a couple of weeks, I think they will take a number of key boxes that they have and the benchmarks that they set for their decision on tightening policy. I think we did see some disappointment on the headline number, but I'd caution about reading too much into that. Because one of the things that we've seen over the past 4 years is a tendency for the initial August print to come in quite weak, only to be revised significantly higher. In fact, on average, it has been revised higher by close to 100,000 over the past 4 years. So, in effect, that's essentially saying that this report could mean that in a few months' time, we'll be looking back at August and thinking that we've created close to 300,000 jobs. So for the Fed, I think this is exactly what they would be looking for to tighten policy in a normal environment, and that normal environment no longer exists here.
Right, it doesn't. You're one on the street who thinks that they're not going to go in September and raise rates. You're all the way out into March of 2016.
Yeah, absolutely, because it's no longer a matter of whether or not the economy is sustaining the positive momentum of the past few months. It certainly is. The labor market recovery remains on track. That certainly is encouraging for the Fed. I think the bigger question for the Fed is the outlook for growth and, more importantly, for inflation. And that must be seen in the context of what's going on globally and particularly in China. We did have some significant market volatility, intense turbulence in global financial market, and that's not what's going to cause the Fed to be cautious. It's the implication of that and the signal that is sending to domestic consumers and domestic businesses. I think because of the uncertainty that entails for U.S. activity, whether it's hiring activity, investment activity on the business side, or even consumer spending activity, the Fed it has essentially clouded the outlook for both growth and inflation for the Fed. And I think because of that, the Fed will take a pass in September. And given my expectations for inflation to start drifting lower, I don't think the Fed's going to be in a position to tighten policy again until sometime next year.
All right. Milan, we'll leave it there. Have a great long weekend. Nice to see you.
Well, thanks for having me.
He's with TD Securities. Georgia is becoming a lead player in the television and film industry thanks to a generous tax incentive that is now 7 years old. It has helped Georgia earn the nickname Yollywood, though the industry's growth is causing some labor pains as well. Pains that the state hopes to ease with training programs designed to give more of its residents supporting roles in TV and film. Mary Thompson in Atlanta tells us where the jobs are.
Georgia is building a name for itself in movies. Thanks to a generous tax incentive, the state is now third in TV and film production behind California and New York. The state welcoming the industry's rapid growth and the estimated $6 billion in economic impact it's bringing this year, though not everything is peachy.
We've had a little bit of a growing pain just in that we've had such a run up so quickly.
So sometimes it's hard to find in-state electricians, artists, and others needed to staff a movie or show. Something EUE Screen Gem Studios' Chris Bagwell says could cause the industry to look for locations outside of Georgia.
It's a lot cheaper for production to hire local talent than to bring folks from LA or New York and have to pay their housing and per diem and everything else.
Lee Thomas heads the state's film and TV office. Along with keeping the tax incentive in place, she says Georgia needs to train workers to keep the shows and movies coming. So Georgia's launching a film academy to train and certify entry-level workers and retrain others looking to polish their skills for film.
It'll be something that you can quickly put people through for very specific types of jobs, and if they want to go further with it, these certificates will be applicable to longer degrees.
About 30,000 Georgians work for the TV and film industry, which the Motion Picture Association of America says pays an average salary of $84,000 a year. It's one reason why Rachel Crump, a widowed mother of 4, has gone back to school to be a script supervisor.
It seemed to be where all of the focus was going in Georgia.
While for Rick Harris, it jump-started the air conditioning business he launched in 2007, cooling the set of the movie The Blind Side.
Since we started in 2007, we basically doubled in size and equipment and staff, everything for the past several years.
He's gone from 2 units to 130, 2 employees to 14, and $1 million in revenue to several million, proving you can make money in movies as a supporting player, a cast Georgia is looking to grow. From Atlanta, I'm Mary Thompson for Nightly Business Report.
Still ahead, will the cheap gas last? There's one big wild card that could send prices at the pump higher. Nissan is recalling nearly 300,000 vehicles, specifically its Versa and Versa Note models, to fix a console panel that could catch the driver's shoe and delay braking speeds. There has been an accident related to the issue, according to Nissan, but no deaths have been tied to that problem. Gasoline is cheap. It's expected to get even cheaper. And as we reported last night, drivers will take notice when filling up this weekend. But will the low prices last? Jackie DeAngelis looks at the one big wild card that could potentially reverse the trend.
On the eve of the holiday weekend, millions of Americans are preparing to hit the road. And they'll be happy to see that average gas prices are the lowest since Labor Day 2004, and $1 less than they were a year ago. Why the cheaper gas? Well, summer driving season is coming to an end. So will refinery maintenance season. As the cheaper winter blended gas comes online, prices at the pump should fall. AAA says $2 by the end of the year for the average.
Gasoline prices and crude oil prices trade in tandem with each other. So if you see one drop, the other one should follow. In the case of gasoline, it could probably drop a little bit more because the market is very well supplied going into the winter.
But not so fast. Crude oil is the wild card in this equation, and it needs to cooperate.
If we get a spike in crude oil prices, say to $50, $55 a barrel, you won't see $2 at the pump for gasoline prices. They will rise definitely along with the crude oil, but it is a well-supplied market, so I wouldn't say that the rise would be the same percentage as crude oil. It will lag, but we won't see $2.
The recent price range for crude futures has been $42 to $48. Many traders expecting that range to hold, barring a black swan event. If there's a breakout, it's likely to the downside. Having said that, the volatility in crude has been unprecedented. In the last 2 weeks, we saw prices jump more than 20%, only to fall another 10%. For this week, up a little more than 2%. So hit the road and relax this weekend, but buckle up for next week. For Nightly Business Report, I'm Jackie DeAngelis.
A nearly $500 million purchase by BlackBerry is where we begin tonight's market focus. The company will buy rival mobile software provider Good Technology. More than half of the devices running on Good's system are Apple products, so the move could help BlackBerry win over more business customers. The stock closed nearly 2.5% lower to $7.28. Amazon is also bulking up. The company's cloud computing unit purchased a video processing startup called Elemental. Some reports estimate the price tag of the deal was $500 million. Elemental helps smooth out streaming of shows and films and other media content. Amazon shares fell about 1% to $499. Netflix, this year's best performing stock, posted its 6th straight day of losses. This is the video streaming company's longest losing streak since March. Shares were off more than 2% today to $98.79. And a downgrade for Caterpillar. R.W. Baird reducing its rating on the mining and farming equipment maker to neutral. This as volatility in China could continue to weigh on the company's shares. The stock fell nearly 2% to $73.10. Our market monitor tonight is a classic stock picker who likes companies he said are misunderstood by the market. He is David Marcus, Chief Investment Officer and CEO at Evermore Global Advisors. It's his first time joining us on the program. It's good to see you, David. Thanks so much for coming in, especially on a long holiday weekend. We appreciate it.
Sure.
You say that you are buying crisis. You never sell crisis. So tell me why.
Well, I think that when there's a crisis, investors generally go into panic mode and they start selling without really thinking about it. They don't care what price they get, they just want to get out. And we think that's when you get your best opportunities. So my view is when they're dumping them, I want to be buying them. It doesn't mean I'm backing up the truck and buying everything in sight. You still have to be smart about it, do your homework, understand what you're buying, but the key is, we really like to think of this as what I would call a nibbler's market.
I was just going to say, that's how you describe it, a nibbler's market.
Yeah, you nibble, you take a small bite, because for example, a day like today, it's a bad day out there.
Right.
You take a small bite, you still have resources to come back on another bad day. If we gobble, we might use up all of our resources. So the key is to take small bites, but always take advantage of these bad days and not freak out, not panic, and just relax. The headlines are much worse than the reality.
Yeah, and stick with your plan. Hopefully you have a plan.
Absolutely.
I know you have a plan, but I'm hoping investors do. So you say that you have been buying. So let's take a look at some of your picks for us. Voya Financial, retirement and annuities. What is it that you like about Voya?
So Voya was spun out of ING Bank, the big Dutch bank, a few years ago when they were going through their crisis. And so Voya, 70% of it is retirement accounts. The other 30% is annuities and mutual funds. It's just sort of a mispriced company, extremely well run. It's only been a public company for 2 years. And so I think investors are still getting to know it. But you have a wonderful, it's what we would call an annuity-like business, because these 401k programs stay there forever. And so it just cranks out cash flow over and over and over. So it's a cheap stock. We have excellent management running it. And I think investors are really just learning about this company now. It's very undervalued.
Kind of an undiscovered gem in your portfolio.
It really is.
WP Glimcher, did I say that correctly? Right. This is a REIT.
That's right. So this is a company that owns 121 retail shopping centers in the United States. Over half of them are enclosed malls, and the rest are strip malls and open-air malls. But this is a company that really is below the radar. It's a $2.5 billion market cap. And part of it was spun out of Simon Properties about a year ago, which is the biggest mall operator in the United States. And then that company, Washington Prime, acquired Glimcher. So it's now called WP Glimcher. And investors just don't understand it. When it first merged or did the acquisition, the stock was 20. Today it's 11.5. You're getting just under a 9% dividend yield. It's extremely undervalued.
Let's go on to your last one, which is very quickly, which is ING, which spun off Voya. So you still like ING?
Yes, we like it a lot. So this was bailed out by the Dutch government a number of years ago, and everybody hated it because the goal was to go back to its roots in traditional banking. Well, the newsflash is traditional banking can be highly profitable. So as they sold the non-core assets going back to their roots, profits grew. They were selling things like Voya and some other businesses. And slowly investors are waking up to the value. And it pays a tiny dividend today, but that's going to grow as the business continues to improve. And it also will participate in the growth of Europe, where we spend a lot of our time as well.
That's right. You like Europe a lot.
Love
David,
it.
we have to leave it there. Thank you so much. You've had a very good year, so good luck.
Thank you very much.
Appreciate it. David Marcus with Evermore Global Advisors. Well, a select group of the world's most influential CEOs and politicians are meeting to discuss the outlook for the global economy and some of the key risks that have been dominating the headlines in the last few weeks. Julia Chatterley has more from this invitation-only event in Lake Como, Italy.
Here at the Ambrosetti Forum on the shores of Lake Como in Italy, top of the agenda very much was China, the risks surrounding the economic slowdown that we're seeing in this country, but also the policymakers' ability to contain some of the spillover effects, like the volatility that we've seen in the equity markets recently. I spoke to one of the key advisors to the German Chancellor Angela Merkel and asked just how concerned he was about the spillover effects.
I think it's a much more important problem than Greece is for the Eurozone. Because when you see this transformation of the Chinese economy, liberalization in several respects, to the extent that liberalization is taking place, the Chinese government is losing control of the economy. And then it's going to be much more difficult to counteract any adverse developments of its economy.
The weakness in China also feeding into commodity prices globally and having a further downward impact on oil prices. That then having a detrimental impact on one of the biggest oil producers in the world, Russia. I caught up with the Deputy Prime Minister of Russia and I asked him whether there was any possibility of Russia working with Saudi Arabia to cut oil supplies and try and raise prices.
For Russia, given the structure of production, it's very difficult to cut supply artificially. If oil prices will be low enough for a long period of time, supply will go down in a natural way. And I think this is the most efficient stabilizer for the market.
So for anyone hoping that the world's two largest oil producers, Saudi Arabia and Russia, may be able to come together, coordinate on cutting supply in order to lift prices, look at this stage to be sorely disappointed. At least for now. We've also got the burgeoning migrant refugee crisis. The crucial question is, can European leaders come together and form some type of unified response to address this crisis? At least for now, the talks on a solution will continue. For Nightly Business Report, I'm Julia Chatterley in Italy.
Coming up, reaching the next level. Meet the entrepreneur who's connecting aspiring athletes with coaches and creating a successful business in the process. It's tonight's Bright Idea. Here's what to watch next week. The bond and stock markets closed Monday for Labor Day. The producer price index is due out, a key gauge of inflation. Apple is expected to unveil new products at an event on Wednesday, and that's what's up next week. Some 40 million Americans under the age of 18 play some kind of organized sports. And for many of them, their coaches will be among the most influential people they'll ever meet. And that's why coaches love coaching. But the business of coaching often involves a lot of extra work. At least it did, until one young man from the Boston area got the bright idea to simplify it.
Set! Football is a team sport. But Shalik Billups is working one-on-one with coach Kevon Watkins. It's the kind of attention Watkins says he never got when he played in high school and while he was in the U.S. Marine Corps.
Nothing like this was ever even thought of.
Individual coaching is nothing new. Watkins has been doing it for about 10 years. But now, he says, finding customers, collecting reviews, and maintaining his business is much simpler, thanks to a website, CoachUp. The site vets and ranks 15,000 coaches in individual and team sports across the country.
This is good.
Jordan Flegel came up with the idea for the site back in 2011.
If you want to learn the guitar, you get a tutor. If you want to improve your SAT score, you get a tutor. But in sports, they're on their own to learn how to play their sport, how to really learn it. We don't do that in academics. We don't do that in anything else. Why do we think it would work in sports?
Flegel's sport was basketball. He'd never heard of working on a team sport with an individual coach before he tried it during his high school years.
I was a very, at best, mediocre high school player.
Mediocre, that is, until a camp counselor, Greg Christoph, helped Flegel develop into a high school and small college star. He even played professionally in Israel for 2 years. But Flegel says the coaching he received didn't just change his game, it changed his life.
That led to a direct improvement for me academically. You know, hey, if I really apply myself, I can figure out anything. I can figure out how to become a better athlete. I can figure out how to become a better student. And I can learn to really write a paper. I can learn how to build a startup.
Flegel began to do some coaching himself while he was in college. Later, after a broken foot and then business school ended his playing days, he kept on coaching to help ease the transition into the next stage of his life.
I created my own website. I had to pay a website designer to do that. Every time I wanted to update something, I have to pay that designer to do it. I wanted to collect reviews. I just wanted to work with kids, and I wanted the rest to take care of itself.
Flegel says CoachUp provides a platform to deal with the business of coaching so coaches can focus on what they do best.
We provide insurance, we provide payment processing, we provide customer support. I mean, for our coaches, we're their marketing department, their technology department, their personal assistant, we're their website host. There's no great solution for me, so I decided to build it.
Most of those services are outsourced from CoachUp's Boston office, home to 30 full-time employees. The model has attracted investment money from world champion athletes like Julian Edelman of the NFL's New England Patriots and Steph Curry of the NBA's Golden State Warriors. Each has benefited from working with individual coaches.
Bring it back, there we go.
For most players, though, the next level isn't a world championship. Shalik Billups is just hoping to make his high school team. But with a little help from Coach Watkins, he may have a better chance to bring his A game wherever he decides to go.
Let's go, push, push. Everything we apply on the football field can apply to everyday life. The biggest thing for me is hard work. You know, you have to work hard in order to make yourself better. Don't talk about, jog back.
Flegel says more than 200,000 young and old athletes have found coaches on his site in the 3.5 years that it's been up. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching, and be sure to join us Monday for a special Labor Day edition of the program.